Hey there. So this is going to be our last tutorial on finding value drivers. I've labeled the tutorial Finding Value Drivers on Depreciation, Interest, and Tax Rate, but the handy thing for us is that we actually have already calculated our interest rate on debt and our tax rate. So our interest expense, our gross interest expense, we got that on our weighted average cost of capital, right? I calculated that Hershey's cost of debt was 4.73%, so that's the value I'm going to use to forecast their debt in the future. Their interest expense in the future. We'll have to do interest income separately, but tax is also easy because we used the weighted average cost of capital calculation to calculate their tax rate. Phew, with those two out of the way, wasn't that easy? Isn't it nice when it's easy? We have two more things to calculate. The first thing is going to be depreciation and amortization. Depreciation expense is based off of our average balance of plant, property, and equipment at cost. Right? We use that average value because all we know from the balance sheet is that we have some value of plant, property, and equipment at the beginning of the year. Right? This would be January 1st, 2013. And then at the end of the year, December 31st, 2013, this value has gone up. So there's some average balance of plant, property, and equipment on which this depreciation and amortization expense is based. So we will say that it's equal to our depreciation and amortization divided by the average gross plant, property, and equipment at cost. That little green tag in the window lets you know that the formula in that cell is different than the formula above it. And we're hovering somewhere around 6%. And then we can use the average of that. Boom! Especially if I calculate the right, especially if I use the right formula. Let's try it again. Did you hear me? I was getting all cocky and then I put in the wrong formula. There we go. We're going to call this 5.9% of gross plant, property, and equipment. And while we're at it, let me label this percent of total debt, right? Current debt plus long-term debt. Okay, so interest income, it runs the same way. Interest income is based off of our cash equivalents and short-term investments. The value at the beginning of the year is $728,000, ending at $1 million. We earned interest on some balance between those two, right? So we're just going to come over here to interest income and say that we've got our income divided by the average balance of cash equivalents and short-term investments. Looks like we've got a very low interest rate. So they're earning 0.3, 0.2% interest. Well, interest, I did drag it over, but let's pretend I didn't. Right? 0.34% is the most current interest rate, reflecting the current interest rate environment. So we're just going to use 0.34% of cash and short-term investments. Great. That's it. You are done. You have all of your value drivers. Anything that's not a percentage of sales, label it so you know where you're going with these things. And from there, we are going to move on to forecasting. So this should take you through the end of project part 2, and I will see you next week, or in a few days, whenever that is, that we work on project part 3. So happy calculating. Like always, let me know if you have any questions.